The fire trucks came to the last fire that we had, and they never left. So they left a bunch of facilities in place that might, and I stress might, provide something of a safety valve or a shot of water on whatever fire might come up in markets. But we're really talking about two different things here. One is the internal workings or the plumbing of the financial system that could potentially get gummed up. The other is the broader economic impact and in financial markets, and both are risks that are out there for investors.
So we're looking, Steve, at interest rates. And
one thing we know about balance sheet policy is announcement is when all of the things reprice. We do continue to watch it because as we actually do the job of removing or reducing the balance sheet, we could see more. So I'm watching financial conditions to see that. But, you know, something between 25 basis points to 50 basis points is sort of the modal outlook. There is no consensus on this. Some people argue it's much less. Some people argue it's much more.
So, Kelly, you know, that could be 25 to 50 basis points for the economy, but for stock valuations, it could be a whole lot more.
What else do you think is important here to highlight, Steve? The interplay between rates and QT, the fact that Fed officials this week sound a lot more hawkish than they did last week, the fact that rates are on the rise once again, and it's with Bitcoin and others down, it's starting to feel again like a bit of a liquidity pull.
Yeah, I mean, I think all of that's important to highlight. The things I'm focused on are, first of all, figuring out, there have been some pretty dramatic reports about how much stock valuations have relied on QT. There was a report from Bank of America that said basically a lot of the excess increase in valuations above what you'd normally expect from earnings comes from the Fed doing quantitative easing. And so the idea that you've seen these massive fall-offs in equity values, especially in the NASDAQ, especially with some of the cyber assets, those suggest to me that QT or QE had a big part in their valuations. And the other thing, obviously, is what President Daly just mentioned there. I have to watch some of the inner workings of the financial system to make sure that the Fed can reduce this balance sheet and not end up with some kind of freezing of liquidity. So I have no problem, or I don't have a problem. Of course, I don't like it. If the Fed is going to reduce quantitative easing and reduce the balance sheet and do so for economic purposes to get inflation, what you don't want to see is the financial system gummed up.
Quick final comment as we start to move through this whole period. Nothing about this is on autopilot, right? I mean, we've seen this in the past where they want to leave it kind of conditional and open-ended, but have they given us any kind of target size or date or anything of that kind?
Not necessarily. I mean, the Fed would like this to be on autopilot. They don't want to adjust this the way they're adjusting rates. What they want to do is bring it down to a place of where it was before the pandemic, but above that, taking account for the fact that the economy has grown naturally, and they want us to live in this ample reserves regime, which, you know, whatever that means from the Federal Reserve, a lot of people are pegging something like $6 to $7 trillion down from $9. So wow. $2.5 to $3 trillion is the number out there in the market for how much quantitative tightening we have to now endure.